Well, what you're talking about is precisely what I'm doing. I have a lot of liquidity. There is a lot of turmoil in the market. And while there's no guarantee of this, turmoil occasionally breeds real market panics. Turmoil occasionally breeds something like 2008. So mostly what I'm doing is I have a shopping list of opportunities that I'd like to avail myself of, companies in some cases, and I'm maintaining liquidity, looking to take advantage of that. I have a shopping list, frankly, of about 50 or 60 securities, as an example. And I have a nibble price, which is to say a share price that I would begin to establish a position in. And I have a gobble price, which is to say a price where I would really, really, really be an aggressive purchaser. On the other side of my portfolio, I have some speculative positions that I bought a year and a half or 2 years ago because they were really unloved. And I thought, well, I'm going to trade out of these things when they return to favor. So I'm doing that too. There are some companies that I think, in a speculative sense, are approaching their full value at this stage of the market. And I'm cycling out of those, looking for opportunities. So my portfolio is in flux. I would say that the dominant characteristic of my portfolio, relative to many other portfolios, is liquidity. I own, relative to the size of my portfolio, a lot of gold. And I have, relative to other portions of my portfolio, a lot of short-term cash, a lot of liquidity. I'm overweight the gold miners for two reasons. I became an aggressive buyer of the large gold miners 3-4 years ago. And those positions have done extremely well. So the gold miners have become a bigger portion of my portfolio, partially organically, which is to say positions like Wheaton Precious, Agnico Eagle, Lundin Gold, G Mining, Franco-Nevada. They've gone up so much in price that the aggregate value of my gold portfolio is up over 150% before portfolio additions. But in addition to that, I believe that we're fairly early on in a gold bull market. I've lived through, this will be my fourth gold bull market, and they follow predictable patterns, Jesse. The metal moves first. When the metal has moved far enough, fast enough, that the gold price has outpaced the inflation in the inputs to produce gold, the margins in the biggest and the best gold companies move. You'll remember, Jesse, some frustration on the point of your listeners in 2003 when the gold price moved, but the gold miners didn't move. There were two explanations for that. One, the gold price moved because central banks were buying it. They don't buy gold stocks. The other was that the cost of producing gold was increasing as fast as the gold price. Beginning in 2024, the gold price accelerated faster than the inputs, and you started to see rapid margin expansions in some of the better gold producers. Two things happened there. They became worth more, but they got assigned a higher multiple too, as the narrative of the gold price extended to the gold miners. This occurs when you're usually about a quarter of the way through a gold bull market. So I suspect, if past is prologue, that we're a quarter of the way through this gold bull market. I believe, Jesse, that the cause of this gold bull market is primarily the deterioration in the purchasing power of the U.S. dollar, particularly relative to the interest being paid on U.S. dollar-denominated savings, which is to say negative real interest rates. And I believe that phenomenon will be with us for a fairly long time. Specifically, I believe in the next 10 years that the U.S. dollar will lose about 75% of its purchasing power. It will do relative to other currencies, but it won't do well in the absolute sense. I saw this happen myself in the decade of the 1970s. In the decade of the 1970s, the U.S. dollar lost 75% of its purchasing power. I mentioned this in this discussion because in the 1970s, the price of gold went up 30-fold. I'm not suggesting that the price of gold is going up 30-fold from here, and we could discuss why on another interview. But I do believe that the gold price will keep pace with the deterioration of the U.S. dollar, which is to say, I don't think that gold goes higher. I think it goes much higher. And I think that will expand the earnings of high-quality gold companies, and I think it will expand the multiples that they're accorded too. That's a very long way of saying I am long the gold stocks and looking for opportunities to increase my exposure to high quality seniors and high quality juniors? I'm not. I think the gold silver ratio is a factoid. I think it's a useful factoid for traders because so many people believe it. Something doesn't have to be true to be important. The gold silver ratio refers to the difference between the relative price of gold and silver and their relative abundance in the Earth's crust. People like it because it's an easy to grasp statistic, but I think it's pointless. It doesn't take into account, as an example, the cost to produce gold or silver. Most silver is produced as a byproduct of other metals, which means the production costs for 78% of primary silver production is kind of irrelevant. It's low, unlike gold. It doesn't go to utility either. My experience has been that precious metals bull markets follow predictable patterns. The momentum is established by gold because the first buyer is a fear buyer. When the momentum in gold has attracted enough generalist investors that they come into the narrative, leadership changes from gold to silver. Perhaps because of silver's relatively lower unit cost, perhaps because of its reputation, historical reputation for volatility. I don't know why, perhaps both. I just know that. When that happens, Jesse, you won't need Rick Rule to tell you it's changed. Those moves are generally very dramatic moves. So in answer to the first part of the question, I'm overweight gold. I have a weighting in silver, but my suspicion is that we don't see a real rip-roaring silver bull market for as much as a year or year and a half. And it's a higher risk circumstance. I have about 2.5% of my portfolio in silver stocks. It wouldn't surprise me to see that become 20% of my portfolio organically with no additions. But it wouldn't surprise me either to see that move take place 2 years from now, 3 years from now, 4 years from now. I have the financial and psychological wherewithal to wait 2, 3, 4, 5 years. Many speculators don't. I also have the psychological makeup that I can stomach a lot of volatility. Small silver stocks can increase or decrease 10% in price as a consequence of the disposition of one institutional investor. They can go up or down 10 or 12% for no reason whatsoever. It takes a fairly large degree of psychological maturity as a speculator to stomach that volatility. I've had 60 years to learn that kind of patience. So I can do it, but many can't.